All right. Lots and lots of folks from all around the country on the webinar today. Thank you all for joining us. I was talking with a friend this week who runs a mortgage lender. We were talking about fear of the unknown, fear of the things out of our control. I remember refinancing my house last fall. And because I own the company, I have some weird or trickier elements to getting mortgage done. And, I have like plenty of equity and income, but so I should be able to get a mortgage refinance done. But the problem is you don't know. And do I have all the documentation done right? Can they do a second home? So you just like submit these things and you just wait. And so even in a place where in the real estate market where I am should be in a fairly confident zone, I feel fear. What if this like deal is evaporating while I wait? What if I'm losing my best mortgage rates while we sit around and wait? All these unknowns are exacerbated by an emptiness of communication. Like I joked in my refinance process that I need constant reassurance. Like everything's going to be okay, Mike. Sometimes, it's funny, even when I'm like in those moments where I'm feeling the least secure about being able to get, for example, the refinance done, I say to myself, maybe I'll just skip it. Maybe I'll just avoid all the worry. And these fears were just over a refi. Can you imagine the fears that your potential buyers and sellers have right now? Like, how much do I overbid? Is it appraisal going to come in okay? Like if I sell now, can I find a place to buy? What if this moment is the market top? What if? Like all of those questions, like these are home buyers and sellers. And what's more important is potential sellers and buyers are living in this fear right now. And that's where we are today. And that's why we're here today. So we are going to spend the time with the market data. This is what market data is for. It's our job to eliminate those fears for the buyers and sellers. And your market data is the most powerful tool for doing so. It's the real information. It's always fresh. You can have it in their inbox every week. Like that's why we're spending time with the market data today. So, in general today, we'll look at where we are in this right now in the second quarter and where the leading indicators show us the market is heading the rest of the year. We're going to spend some time talking about what we're calling the immediate sales phenomenon. So Cynthia, who was in the chat just a minute ago, talking about the broker had 4 homes on the market. They listed them Thursday. They had the deadline Sunday. They had hundreds of showings and 53 offers for 4 homes. Like those immediate sales are dominating the market. And I'll show you what that means and how we can use it to understand what's going on. And then we'll spend some time with the local looks, the Zoom towns, the hottest markets, and we will see where the local things are heading. The crazy phenomenon is the whole country, all price points, but are we getting some return to some normal seasonality? So that's what we're going to look at today. Before we dive into the data, I will always like to remind you if you haven't already, you should go to altosresearch.com and get the ebook right now, How to Use Market Data in Your Real Estate Business. So I'm talking about like how to do this, how to use the information to help your clients not be afraid. to help potential sellers not be afraid. Like that's what we're doing here. There's a link to the ebook in the chat, and so click through and go get that. And as we're talking, you'll see, especially as we use in the second half of the session today, we'll go into some of the Altos reports and some of the local markets, and this ebook will tell you how to use those reports to communicate. There's some scripts, there are some scenarios, all the marketing phenomenon. So make sure you go get yourself that ebook if you don't already have it. All right, let's dive into the data. So, we've been talking about the inventory crisis. We are way down from a year ago, and every year for the past decade, we've had fewer and fewer homes for sale. If you've listened to the webinars that we've done over the last few months, you'll understand that this phenomenon is really driven from low rates. Low rates mean it's easier to buy, but it's also easier to hold. So the low rates have restricted supply as well as spurring demand. The only time when we have had increased inventory year over year in the past several years is this period between January 2019 and the spring of 2018 and the spring of 2019. Year over year, we had an increase in inventory. During this period, the last 8 months of 2018, we had rising mortgage rates. Specifically, rates climbed above 4 to 4.5%. And as a result, demand dropped and supply increased. Now, since that time, we've had rates just falling through the floor. There are some signals right now that rates may be rising. What we don't know is how quickly they're going to rise, how far they're going to go. And therefore, we don't yet have visibility on what's going to happen with supply and demand in the rest of the year. But what's interesting is, we'll talk a little bit more about that in just a minute. So 310,000 single family homes on the market in the US right now. This is unsold inventory. So when properties are getting listed and getting snapped up right away, they're essentially bypassing the active inventory. They're not sitting around any time to be analyzed. They're going right into contract. That immediate sales phenomenon is really fascinating and is really strong right now. So we'll take a look in just a second about where that is. The important thing to note, and the thing that we are keeping looking for in the inventory number, is that we have, if the far right side of this chart right here, we've stopped falling really dramatically each week, and looks like we're coming to the bottom of the cycle. If you look at previous years, you have several 6-8 weeks of slow decline before you have a climb out to the end of the second quarter to the peak of the summer. Now, if we get seasonality, which we lost entirely last year, if we get some seasonality, that would mean that maybe by the end of April, we start getting some inventory climb to peak probably in August of this year. Some of the signals for seasonality is that schools are more universally back, and certainly by the fall, they're more universally back. So that school timing is one of the drivers of seasonality. So, people selling for the summer and buying before the school starts in the fall. So fingers crossed that we'll see some seasonality. We'll actually get some building of inventory this summer. We will still be way under. And even if we get in a situation where some of the homes that are still in the mortgage forbearance program, still 2.5 million homes in that mortgage forbearance program, even if we get to a situation where those are going through for sales, Most of those are refinancing, and they will stay in the home, and so there's some servicing work to do there, but not most of those are not looking to be entering the active inventory. So no flood, but some signals of seasonality. So hopefully by the end of April, we see that climb. So let's talk about this immediate sales phenomenon. The immediate sales are absolutely dominating the market, and this is true for the whole country. It's true because mortgage rates are still ultra low, and we have lots of equity, and for home buyers have built a lot of wealth this year. For those people who are already, for example, priced out of the market, those were the ones who are most hard hit by the pandemic. They weren't buying homes anyway. And so those folks are not buying right now. And the ones who are most hard hit by the pandemic are not buying now. The people who are getting the best deal they've ever got. So here's what it looks like. This is looking at weekly data, where the dark part of the bar here is new listings that have come to market and made it past a week is basically what that's showing us. We can see that the new listing inventory, at only 60,000 a week, is way under where we need to build inventory. But we add back in another 25 or 30,000 the immediate sales, and now it's 90,000. So 90,000 single family homes is just about, it's still tight, but it is just about to a healthy place in the market, which says that this is why we know we're getting lots of transactions happening, even though inventory is super tight. It is this immediate sales that is dominating. As the year progresses, and if we get into a point with, for example, rising rates, and we see the market slowing, we should see the lighter part of the bar here shrink, the darker part of the bar increase, and that will have us approaching more normal seasonal patterns. So if the light part of the bar increases, that gets even more scary. We're in peak buying season. We're in this point where we're typically in the lowest, fastest days on market of the year. That actually peaks in May. By end of June is our normal seasonal peak. And then people start doing price cuts and things to make sure the house sells before the end of the summer. So we are both in the peak of the cheapest mortgage as well as the peak of the buying season. And this is what we're seeing right now. So really a third of the market going essentially instantly. Here's what it looks like in the other direction. So of the homes that are sold last week that went into contract, 34% of them were immediate. And when we talk about immediate, it's really, we put on the market, we're taking offers, and we're making a decision. And usually sometimes it's hours, sometimes it's done before it actually hits the market, but sometimes it's days. Sometimes that little process takes days. And whether you say you're taking bids Thursday, you're taking bids Sunday, we're still calling those immediate sales. So in this sense, it's immediate sales. 34% of the market is immediate right now. If we include those that have gone after only 1 week, it's 64% of the market. That's the dynamic we're facing right now. So, for the communication to sellers, this potential sellers, the most important thing, the fear is should I do it now? Should I wait? Should I do it now? If it would be better to wait, should I do it now to take advantage of this demand is one way to show to your sellers, your potential sellers, that the market is here right now. We can show over time, if this shifts, you could show that the market is cooling and therefore help encourage them to take action immediately. But this is the mix that we're seeing right now. 64% of the homes are going essentially in 1 week. It's nuts. Okay. Pricing. What does that mean for pricing? So median home price in the US this week is $374,000. These are asking prices. We are 15% higher than last year at this time. You can see on the chart here on the red line, a little dip was our pandemic lockdown. We had 3 weeks of down pricing last year. Right now is comparing one of those weeks. And then after 5 weeks, we were back up above our normal, our previous peak. So we had 3 to 5 weeks of pandemic pullback last year and then unleashed. So we're in this point right now where the year-over-year comparisons are really high. When we look at the gray-green line here, that's the leading indicator of the new listings, the price of new listings. These are the new listings that come to market each week, and they use the wisdom of the crowds. You know that the one down the street had a bunch of multiple offers over, so the new listing gets priced a little bit higher. The new listings plateaus earlier in the season than the market as a whole. So last year, the new listings plateaued in July, the market as a whole, not till August. And it didn't even really pull back until later at the holidays last year. But in a normal season like 2019, you can see the new listings will peak in May so that the market as a whole peaks at the end of June. Then by July, you start getting some price pullback as people want to move before the end of the summer. So this is the seasonality we're going to be looking for this year. Hopefully we return to some sense of normalcy there. You can see the quick pullback that the new listings did last year for 3 or 4 weeks before they rapidly appreciated again. So we're in our little plateau. This early second quarter plateau. It's exactly the way it should look for good seasonality. It is super strong. So there's no indication, of course, that prices are going to pull back the rest of the year. Like we have a 10 to 12% price appreciation year for homes in the US, essentially in the bag. That's what that's what the pricing is telling us right now. Here's our year-over-year comparison. So, we've had this 5-6% range over the last several years, maybe as high as 8% in some of those points. When we started 2018, prices hadn't kicked in yet, but the demand was there. We could see it was coming. We have our 3 weeks of pandemic pricing declines. So there were year-over-year pricing declines. So early April of 2020 was lower than early April of 2019. And then we rocketed. And so right now we are comparing with this down part. So we're over 15% year over year price increases. 15% is nuts. It's nuts because it is a massive generation of wealth for homeowners, equity, massive generation of equity for homeowners. It also it does things like it sets a new floor for listing prices in a neighborhood. So we start, as they get sold there, the comps come in, the appraisals come in, and and they adjust very quickly. So all of a sudden the value gets locked in over time. I have a poll that I want to ask. Of your recent appraisals, your recent sale, the appraisal came in below, at, or above the contract price. When we're in rapidly appreciating markets, one of the great fears is that will the appraisal come in? Will the appraisal, we're going to overbid. And I was talking with an appraiser colleague recently, and we were just discussing what's happening to those. If you have it where you're doing a significant overbid on a house, and then the appraisal doesn't come in, what are the clients doing? Are those contracts falling through? His observation was, for the most part right now, the contracts are not falling through, although sometimes they are, but mostly the buyers are coming up with more cash to get the deal done rather than letting the deal fall through. And it's fascinating because when you put that much cash into your house, it's significantly less likely to do things like default in the future. So I still see a lot of bubble talk. Are we in a housing market bubble? Is it going to crash? The fact that we have such strong equity is really different from 2006. And while, there's lots of scenarios where we can get prices to back off, decline a little bit, a bubble burst does not feel like we have anything in the market here. So let me end this poll and share the results. So interestingly, we still have 9% of the appraisals that coming in higher than the contract price, but 30% coming in lower than contract price. So that, those are real implications there. Again, it's something for you as a real estate agent and us as real estate professionals to help take the fear out of our clients. And 62%, I think the appraisers know exactly how hot the market is right now. And so 62% of the appraisals coming in at is a pretty encouraging number. But 30% of those folks will have things to handle in their contract process, their closing process, to make sure that they get that house done, that deal done. That's pretty interesting. Okay. Let's look at our leading indicators. So our price reductions, this is the percentage of homes on the market taking price reductions. This is normally in that band between the upper 20s and upper 30s. Think about it as a 35% of homes get listed, they take a price cut before they sell. That's a normal rule of thumb. When the market cools, like in 2018, as mortgage rates were rising, the price reductions peaked higher than they were before. So they were climbing here. And that's what we know, that we're going to get more inventory. We're going to get price adjustment down or softer. When price reductions climbs over 40%, 45%, now we're looking at as a real bearish signal in the market. But of course, right now we are at 16.3%. We are at the lowest level ever for price reductions. This is, of course, a function of the overbids, the immediate sales. But what it tells us is that for the remainder of the year, we are so far from anything that's going to be soft, like that our price appreciation is pretty much locked in for the year. So homeowners have another 10, 12% of equity building for a second year in a row. It's really a remarkable situation to be in. We do see a little bit of uptick here, and it's actually happening a month later than we normally would. So normally by April, we start seeing, you get a big bulk. February, March, you get some good inventory. By late April, you say, oh, those that didn't sell, start taking price cuts. By June, now let's start moving things, because by the end of summer and into the holidays, now it's like, man, if it hasn't sold by the holidays, we start taking price cuts. So that's where your seasonality is. It's usually this low in March to a peak in October. Last year, of course, we had no seasonality and things just went nuts. We had, and so right now we're starting a little bit of an uptick. And again, this is encouraging to me because that means we're back into a more seasonal pattern. That means we'll get a little bit of inventory building. That means it's a little less nuts for your buyers and a little more opportunity for your sellers who say, I am afraid to sell because I don't know if I'll have a place to buy. We have a lot, the percentage of active listings with price increase is the opposite view there. This is a view of, this is what typically is things like fix and flips, investor opportunities, and it price increases has a normal seasonality. You come on strong in the first quarter, by then later in the year, there's fewer of those. And so there's an investment timing, a cycle, an ebb and flow of the market. What we've got right now is we had this massive price appreciation. So these are homes that were on the market, that came off, they went back on the market at a higher price in like 90 days. We're at 7.5% of the market, which is a remarkable high. Vastly higher than most years at this time. We do have the new Fannie Mae rules on investment properties. So Fannie has just said that the most recent portfolios that they've been buying have averaged 14% of their properties have been second homes or investment properties. And they've limited that to 7% now. So it's dramatically increasing the cost of mortgages for second home purchases. In the local data, I'm looking for that in what we've called the Zoom towns. These are the places where people moved out of the cities to work remote for the year. And those towns had huge price appreciation years. And so the question is, does that mortgage change demand? And can we see it in the data yet? So we're going to take a look at that to see if we can see it yet. This number is not still increasing. So that's encouraging to me, as it looks like we should be able to get some seasonality. This will come tick down for the rest of the year like that. Any amount of seasonality feels healthy to me. Anything where we stay outside of the seasonality feels like we get more frothy, more speculation, and that makes me worried. Here's where we are in mortgage rates. So we've talked about how low mortgage rates generate they actually restrict supply at the same time as they increase demand. We had our peak at 4.9% at December of 2018, and then more than two years of declines. And during this time is when prices absolutely just went nuts. Since January, our January low, we are up 500 basis points. So we are up over 3%. It's a significant climb, but it is still ultra low, way below our decade-long 4% average. And then this week, mortgage rates ticked down a little bit, so they're not skyrocketing. So all of a sudden, what we're looking at is like they're a little bit higher, a little bit more expensive on the mortgage, but not skyrocketing. And not yet even close to 4%, which is that long-term average. So as of right now, it doesn't look like rising rates are putting a damper on demand. It'll be really interesting to see if in May, June, July, the Zoom towns, or if we continue to get rising rates, if that shifts our demand and supply picture. So far, not yet. Let's look at supply and demand real quick. The supply and demand number that we use at Altos is the Market Action Index. In your Altos report, you'll see it as this little speedometer. And above 30 is a seller's market. And really, we're in the strongest seller's market we've ever measured. And we're in a really fascinating part of the year. So, we have Q2 is the normal seasonal peak. So the top part of the line here is usually end of June before it recedes for the fall. Last year's this dotted red line here, this is the pandemic lockdown. We had notable backing off of demand, but it was so fascinating. We never even got to buyer's market territory. It was only 3 weeks of downturn before the demand started picking back up. And then this year, we've got just this massive demand. It looks like it might be rolling over a little bit to hit our peak. Fingers crossed for our seasonality there. For your potential sellers, if you have folks who say, should I sell now? Or maybe I should wait. You can put your Altos report in their inbox every Monday and say, I want you to keep an eye on this one number, this market action index. If this number starts ticking down below, and you can see that the gray line here is last month and the red line is this month, we're actually higher this month. But if this red one starts ticking down, that's the market telling us that the demand is softening. And we're still in seller's conditions, so we still have opportunity to sell. But if you have been delaying, that'll be your signal to take action quickly. So it's really important to when you hand your reports to your clients, to tell them, look at this one number, because you can actually motivate the action. And then one final step before we move into the local data. I always like to use the market segments part of the Altos reports. The high end of the market may be behaving differently from the low end. Right now, in a lot of markets, they're all hot, but you can really see in this market that I grabbed where the stuff that's around 2 million is still a longer sales cycle. Anything under 750, anything under 900 in this market is going essentially immediately. You can see exactly where the demand is, and you can see where to list price. You can see how to tell your buyers what to expect. So we'll keep an eye. I'll take a look at those market segments and some of the local reports as we do that. And then before we switch over there, I always like to remind, one of the fears is, are we at the top of the market? If I buy now, is it all going away? And the demographics, the age demographics are in our favor. And it's always important to point out to buyers right now that the millennials are now approaching their mid-30s, their peak earning and home buying years. They are the biggest segment of population ever. And they have delayed their home buying. They are buying now. And they will be buying for a decade. So that demographic bodes very well for 5-10 years of home buyer demand. And if we're really lucky, we finally get the boomers to sell and we get some inventory, and then we get some real volume in, as well as opportunities to have equity grow and have millennials buy. So for those afraid of a long-term trend, it's always wise to point out that, millennials are just now hitting their peak. And they've got a good 5 to 10 years of home buyer demand. Okay. Let's shift over to okay. Let's dive into some local data. This is the back end of the Altos system. If you haven't seen it, I like to show it real quick because you have all your local markets that you work. This is mine for the whole country. We get to see who is looking at the reports, which of our clients are using them. We get to put it in their inbox every week. We get to say, if you're thinking about buying and selling, or thinking about selling now, it's such a strong seller's market. We can sell your home super quickly. Here, these are the things to keep your eye on. If you are thinking of delaying, I want you to watch one number. Keep your eye on this market action index. If this thing starts ticking down, that'll be your signal. Don't delay any longer. Okay, that's a quick tour of the back end. We've been looking at the national data. You can see the price range here at the bottom. In general, everything's moving quickly. You can see that the 500, the 3 to 500 range is where in the country the greatest demand is. Things are moving fastest. When you get over $1 million, takes longer, but even still, it's only 56 days at $1 million. Let's switch into the Zoom towns. Truckee, California is where the Bay Area moved last year. It was crazy hot. Truckee is Tahoe, and the prices went through the roof. Inventory plummeted. So last year at this time, 148 homes, and we're down to 29 right now. The things I am looking for here, if as second home mortgages get more expensive, does that mean that days on market starts to climb? Do we get more inventory unsold? Do we have price decreases hit faster? So far in Truckee, none of those things are happening. So we've got 2 or 3 weeks of the more expensive mortgages. But again, those were probably the ones that purchased this month locked before. So they probably were already locked into their best rate. But those are going to climb very quickly, or that the rate that is going to be more expensive very quickly. Some signal that that's already over 4% for the second home markets. And so the question is, do we see any action, any slowing yet in the Zoom towns? In Truckee, nothing yet. 14 days, this peak part of the market here is at 1.8 million. So there's still a lot of cash going after those homes. Let's look at Palm Springs. So Palm Springs was a Zoom town for the LA market. People moved out of LA into Palm Springs for remote work for the year. So the question is, price is up, price per square foot up, days on market still down, price decreases at 17%. Remember that the normal is 35. So crazy hot market. Price increases is actually up to 11%. So that implies more investor behavior right now. And down here, anything under $1.6 million is going in just 10 days. So in the Palm Springs, it's actually increased. The market action index has increased from last month. So the Palm Springs Zoom town, no decrease yet in demand. And then Bend, Oregon is the other one I like to look at. And there's a few on the East Coast too, some of the Hudson Valley towns, et cetera. But we'll just hit these. So this is inventory in Bend, Oregon, year over year. Here's our few weeks of pandemic lockdown, and then the rest of the year. So inventory down, 2/3 from where it was a year ago. And Bend is even more nuts than Truckee or Palm Springs. It's, anything under $1.3 million is 14 days or fewer. Our price decreases is only at 15%. So these markets are still have shown no sign yet of slowing down because of increased mortgage costs. It could be that mortgages have to go well above 4% before we see any demand back off. But as of right now, this is where we are. Let's look at the hottest markets in the country. Boise has been so crazy. Our market action index is almost at 100, like it's almost as high as we can measure it. Days on market in the city of Boise is only 4 days for the whole market. Inventory is, and let's look at days on market over time. We're actually in where we're normally in the lowest days on market part of the cycle for Boise, usually for the summer, and then you start in the fall to get the increase. So normally though we might be even at a few weeks, 3 or 4 weeks recently, and now we're at essentially less than a week. Like everything is moving less than a week in Boise. Price decreases that are under 10%, price increases at 8%. So this is investor opportunity, investor action that's happening here. Normally this is a 2 or 3%, and right now it's at 8% in Boise. Denver has been nuts. So Denver's a bigger city with a little more diversity than say Boise, but our inventory, our active inventory is way down. Our price decreases normally at 35% at 23. Price increases. So price increases here at 5%. Let's check a look here. Percent of properties with price increases is actually climbing. So investor activity in Denver climbing recently, which makes a lot of sense. So and Denver has a lot of the iBuyer activity, a lot of institutional investment. It's a big long-term growth play. So all of those pieces come into play pretty interestingly. In Boulder though, Boulder's higher price, less diverse. And while Boulder is still in a hot seller's market, it's significantly cooler, easier, longer to buy than Denver proper. So these are things that are 2 million and above though, but not moving, same day. It's an interesting dynamic looking at the difference where the price ranges are in a place like that, the Front Range of Colorado. Let's move down to Austin. Everybody's moving out of California, moving to Austin. When we look at Austin, so Austin's not quite as hot as Denver or Boise in that sense, but inventory, way down, 1,400 single family homes down to 483 in, and almost 2,000 a couple of years ago. 3 years ago, we were over 2,000 and we have 400 right now. Here's what's interesting. Ticking up now in Austin, getting a little bit more inventory starting to climb. And I'm actually looking for this. We're having a few markets where we get a little more inventory coming into the spring, and it starts to add up for a change for the country as a whole. So a little more breathing room, but anything under $1 million in Austin, just, going instantly. So just, and a lot of this, I didn't do a breakout of the immediate sales for Austin, but so many of these things are happening immediately that they don't even hit the active markets stats because they're already in contract. But let's contrast Austin with Dallas. Dallas is a bigger city, a little less diverse, has a lot of inbound migration, but significantly less than Austin. Austin's the fastest growing city in the US for the last bunch of years. So here we have price decreases at 24% and bottoming out. So likely going to be at our low here right now, and then back up. Normally Dallas would be, if we look at our price decreases, normally Dallas is going to be in this 30-40% range, because Dallas has generally higher rate of price decreases than much of the country, because we have a bigger supply per population. You have a lot of construction. You have higher property taxes that cause people to want to hold fewer homes. So you sell it rather than holding it, as opposed to like California, where your property taxes are frozen low. Then when you buy the next place, it's a really good deal to hold the first one. So typically you'll see that in Dallas in higher price reductions in a normal part of the cycle. Right now we are at 23%. Let's turn off the 90. We just look here. And so my suspicion is that we're going to be at the bottom here of our cycle for a few weeks, and then we'll get some price decreases up to about 30% as we get some seasonality. So fingers crossed. Like I said, I like to look for seasonality. That feels really encouraging to me. I did a quick check in Gilbert, Arizona, suburban Phoenix. Just for a client the other day, and Gilbert's nuts, off the charts. Here's inventory in Gilbert down from 900 homes a couple of years ago, 300 last year, down to 118. That is and everything in Gilbert 14 days or under. So what's interesting here, so our price increases are at 8%. We were at 12% a month ago. This is a lot of investor activity, a lot of flips, but inventory is so tight, it's actually hard to get these deals happening. So that's tightening up a little bit. Price decrease is only 7%. And Arizona is also typically a high price decrease market. Usually the Phoenix, the Maricopa County is around 40% in a normal market. Last year was 30, was already feeling hot, and now we're at 7. Like, this number has really got to change before we see any fears of, like bubble bursting or any kind of like real negative message. We're so far beyond that like Gilbert is one of the examples of nuts. Okay, let's move east. I was talking with a client. We have new clients in Bridgeport, Connecticut. So we were looking at Bridgeport. Bridgeport's fascinating because unlike some of the West Coast markets, it's not a growth city. It's not an immigration inbound growth city. Median price is 287, which is significantly lower than a lot of these West Coast towns we've been looking at. Yet still in Bridgeport, we are way down. We're inventory is half of what it was. Maybe some signals that inventory is climbing now week to week as we get into the second quarter. So that's encouraging. But our strong sellers market, our price decreases are only 19%. Price increase is 11%, meaning, we came out of the winter and some folks are like, wow, I'm going to sell into this market and gaining some value there on the sale. This is, and then in Bridgeport, you can also see that the stuff that's right around the median, the 275, 300 range, those are the ones that are going the fastest. There's some junk at under 150 that takes a little bit longer. And the stuff that's higher in Bridgeport, it's not a lot longer, but the $500,000 homes is at 56 days. So you can really see where the demand is in Bridgeport. Right here is the sweet spot of the market. And that's important when you're working with sellers, or investors, or like if an investor is thinking that everything is going immediately and they want to buy down here, if they can do a fix and flip and get the quality up to the 275, this is a real investor opportunity here, right? You buy the 150 and you put a little bit in and you sell in the peak range. That's a real good. These are the same. The lot size is a tiny little lot size, but if it's the same lot size, you can actually have an investor opportunity that looks really interesting right here. You will not be able to get up here to $500,000 because those are bigger lots. Okay, Minneapolis has been crazy hot. So, and this is always funny to me because Minneapolis in February, how does that work? But it has been super, super hot. Is one of the ones that NAR pointed out had like the most over bids over asking. So what does it look like on our scale? Hot sellers market. We have our price decreases are down 14%. Our inventory is ticking up a little bit the last few weeks. So again, a little bit of seasonality. You can see normally we're in this part of the year, not tremendously fewer than we have had recently. So these are encouraging signs to getting good transaction volume in Minneapolis this year. Let's move on. Cincinnati. I've got Cincinnati and a couple others open, and then we will wrap up the conversation. Cincinnati is, had a strong price year. We have our price decreases are at 23%. Let's take a look at where that is normally. So normally we'd have price decreases in this normal range, 30, 35%, maybe. So maybe up as high as in the upper 40s. Last year, we started last year strong at 31%, and we're down right now into 23. So in Cincinnati, Cincinnati's also not a growth immigration, like inbound growth market. So these are organic purchases of, folks being buying in market. The market action index is ticking up. So for sellers who want to sell into this market, like now is still a good time. We haven't yet, we want to point out that if this falls, if this starts ticking down, now you want to get in front of the market signals. Okay, let's wrap up here. I started the conversation by talking about fear and this fear that I had with my refinance. We have fears of people afraid to buy. We have people afraid to sell. We have people afraid that they're buying at the top of the market. All of these things are answerable with market data. So if you are investing in your real estate business this year, if you're working with home buyers and sellers, I have a simple recommendation for you. Go to altosresearch.com and book a session with our team. Grab the ebook if you don't already have it, and learn how to use market data in with your clients. We want to put the market data in their inbox every week. The market is nuts, and this is how they know what action to take. So they want you to be their expert, and this is your opportunity. So your clients should have the data coming from you to establish you as their expert. In the craziest market we've ever seen, they need you as their professional guide right now. All right, everyone. Thanks so much. That's all for today. More soon. Recording is available, will be available. Every registration, every person who registered will get an email later today with the recording. It's also always on our YouTube channel. So our Altos Research, it's youtube.com/Altos Research. You go there and subscribe to the channel so that you'll get our weekly videos as well as webinars and other things that come up along the way. All right, everyone. Thank you so much.